This is a video about making a valuation of Amazon, not the river. I've done other videos on that. This is a video about the stock, Amazon. And I'm also probably going to show you some of my psychological problems in more detail in this video. Just wait. Now, I have tried these online classes and I'm crying because I can't travel and I have to listen to the certain politicians on the news and all that stuff. I'm going to have to make an online class though. When I make an online class, now I make these videos and most of you don't watch them and all that. But when I make an online class, the first thing I'm going to do is absolutely limit it to 10 people. You can make enough money with 10 people. I'll charge a little more than $100 probably. A lot. Well, whatever. And then I'm going to demand that you interrupt me. Otherwise, it's just a goddamn video. And these, I hate it when we have one of these moderator persons who said they're going to mute all the mics. No way. You can interrupt me anytime. And I want you, if you're going to do this, you don't have to. Don't get stressed out about anything. But I want email questions before the sessions. We'll have many sessions. I need to know. And I'm going to use that gimmick thing on the Zoom where you can poll, or am I going too fast? Do you want me to go through this in more detail? Whatever. I'm going to make sure that you share your screen. Oh, you're going to have to do some work on the Excel to make sure that you get your hands on. It's like driving a car. You want to practice some of this stuff. I mean, learning to drive, that's what I mean. I'm going to try to have some case studies and use some highly structured examples. Teaching one of these online classes for me is a whole heck of a lot harder than teaching another class. Now, let's talk about Amazon. Now, in Boston, there's a place called Tufts University, and these poor idiots, so sorry, I shouldn't say idiots, because I'm never going to do this. They made like a case study a couple of years ago when you Google valuation of Amazon, and here's what they get. Uh, so you can see this. Now, what you'll of course get all the resources, and I'm really during this virus, I've collected a whole bunch of more stuff. I'm trying to organize it a lot better, but in this featured models, I'm going to go through this Amazon, and I'm going to have a complete model. I'm going to show you how to acquire data. I want to get very, very hands-on. And here's this poor person who did this. Oh, no, this is a different one. This is a different one. Excuse me. Excuse me. Excuse me. Oh, no. Come on. Get back to my thing. Okay. Fletcher. Okay. They did something and they said, right at the beginning, they did their abstract and they said, choosing between Amazon and Walmart. Guess who they chose? You said, Amazon's exciting. They did this in 2015. The poor people, I feel sorry for them. They said, well, back then we found the stock price of Amazon, which was about a fraction of it was today, to be overvalued by 30%. And they said Walmart was much better. And then they went through, look at this. How cool. They went through some graphs and had all these graphs. Now, they didn't show you, I don't see a graph. I'm looking at it very quickly. They had some EV to EBITDA. They had Walmart pictures and good forecasted growth. Where in the heck is the return on invested capital? And where is the forecast for the return on Oh, they did. I take that back. That's no. I don't know if that's forecast or actual. I assume that's actual. Amazon did have a low invested capital. There's no question about that. Okay, so here here's what they said: an investment for the next 10 years, Amazon versus Walmart, which to choose. We picked the stability of Walmart uh, over the uncertainty of Amazon. And at that time, they said the value was USD 460 for Amazon, actual stock price was 240. Demonstrates nothing against them. Please, 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 nothing against them. But it demonstrates the difficulty of valuation. I could have believed them back then, probably now. So after this gives you a little illustration of how I'm going to do their classes. I'm going to ask you, do you want to focus more on the theory or the practice? You want to go through practical methods, and then we'll put your little surveys in there. Do you want to work through modeling issues, real, actual issues? And one of the real frustrations I have with these online classes is I don't see what you're doing. I think I'm going to share the screen. I think I'm going to have you do this. Okay, and then I'm going to give you some of these files that I use. I already talked about this Macy's in another video, so I'm not going to do so much of that. And I'm going to go through, this is going to take a couple of videos, I believe, because I'm going to go through practical issues on how to read the database. I've worked on some new stuff, how to really focus a little bit on different multiples and terminal value that I struggle with. I struggle with it so much. I hope I'm getting there. Maybe not. Okay. And again, in my classes, any one of them, if I teach you standard crap you learn in business school, oh man, I don't want to do that. I want to show you nuances. I want to show you difficulties. I don't want to show you uncertainties. And I want to address advanced issues, even in a class which might be considered fundamental, even for some people who haven't gone through much of these. And I don't want to make any suggestion that I know what the value of Amazon is. What an idiot I would be if I trade shares. I'm the worst. So maybe you could turn it off. Now I'm going to start with some introductions introduction to some valuation issues. And then I'm going to, in this video, no, I think I'll do that in the next video. In the next video, I'm going to go through some practical issues about getting data from the SEC and from different websites if you can't afford a Bloomberg terminal. Now, the first thing I'm going to do, I know I'm trying to structure this, but in any valuation, anything, you only have to do two things. I came up with this ages ago. All you have to do is predict the future cash flow. That's one of the two things. And then you have to assess and put a discount rate. You have to put a valuation on those cash flows, because if you make a prediction of the future and there's more uncertainty associated with those cash flows in real terms, not in nominal terms, we cannot get mixed up between real and nominal. We have to do that. That's where WACC comes in, and PE ratios come in, and EV to EBITDA ratios come in. How do we take those? Those are the only two things we have to do. Of course, those are about the hardest things you can do. I say measuring future cash flow, measuring the future. Look at what's happening today. If you're watching this around the coronavirus time, who knows what's going to happen? We have a zillion different scenarios. And measuring risk for me is like measuring happiness. These people who say they can measure creativity, measure happiness, measure risk, it's almost a fraudulent thing to do, but it's the center, seems to be the center of finance. Now we can go through these wonderful little consulting slides. And at first I thought, what a bunch of crap. But really, Amazon, they have a pretty good competitive position because their people are addicted to them. People love them now. They sit on their PCs all the time or phones, and then they do this. They have differentiated their product and got some monopoly power. The real question is, in the long term, is anybody going to do this? Now, of course, Amazon cannot charge really much higher prices than anybody else, so they do have some competitive pressure, and that's what we have to really think about. And our valuation has to come up with that, of course. But to get there, we have to look at the return on investment, growth, and cost of capital. This I do get this from the consultants, and here's my big problem. People talk about growth a lot, especially with Amazon. But if you grow and you don't earn a return on investment above your cost of capital, you've thrown money down the drain. This is how I think I should start a valuation class. And then whatever this must be, what's the price and what should it be? Well, that's our modeling, I guess. Okay. And then they have these things. And I've talked about these things a lot, but this simple little thing is so ridiculous. You might consider Amazon right now, I'm just going to give you a hint, they have earned a reasonable ROIC. They didn't used to. They used to kind of be in this one. They used to be over here. They had a low ROIC. Well, if it's negative or below the interest rate, you know it's below the weighted average cost of capital, whatever that is. I'm going to I criticize the weighted average cost of capital too much in project finance, not necessarily in corporate finance. Okay, and a power cow says good growth, good returns. And then they said, well, this is a perennial underachiever. Stretched balance sheet may look expensive, whatever that means. High industry growth, pricing power, because they have some monopoly power, because they get you addicted. That's their whole thing. A cash cow, ooh, they're no good, are they? They have low growth and they're just boring. Generative risk opportunity diversification. The cash cows are not good enough in this one. Capital killers, this seems to be the worst. We're having negative growth and bad returns, but it's not that at all. Okay, this is another one. I say, I retitle this. We can call it cash cow powerhouse. This I should call boring. I should just call nice, boring companies in your life. Sometimes I think right now with this coronavirus, boring seems really pretty damn good. This is the worst one. This is throwing your money away on some stupid thing. This is somebody says, I have this wonderful thing I'm going to have you do. These, whatever it is, these vacation homes or something like that. I'm going to get you to throw your money away. And the faster you throw the money away, the worse it is. And this is really not that bad because you're doing one of the hardest things in business. You are knowing when to get out. So these things, when these consultants do it, God, you really want to look at it differently. And here's what scares me. If you're a powerhouse company, like right now, Amazon is arguably a powerhouse company. I talked about Macy's. I don't know if they're down here, they're not growing fast, or down here, they're somewhere between here. Amazon is here. And here's the problem is Walmart, is everybody else going to come in and copy them? And if they start trying to earn too high a whack, everybody's going to come into this business. Everybody's trying to come into this business. And eventually that's going to push their returns over here. And if they get negative because we have overcapacity in the business, then you're starting that when you grow fast, you're just throwing your money away. That's the danger. That's the way to think about this. Now, what I tried to do, and here's what I did with this. I tried to illustrate this with a bubble chart. It was harder than I thought. I thought, this is going to be easy. I just want to show, these things show you the value, the blue areas. Where's the biggest value? This one is the biggest over here. And this one is a high return, kind of not that gigantic growth. It's a lot better than this one, which is a high growth, but not so high return. And then when it's a circling, when you make these bubble charts in Excel and there's a little circle, that means they're negative values. And these are kind of like just about zero or nothing. These are slightly positive. And the way I did this, and what I've tried to do now, this is going to be one of a couple of videos. First of all, here's this course I tried to deliver. So we have hands-on sessions, we understand the theory of the models, and here's our agenda, making a nice model and getting advanced in multiples and talking about different kind of ways to do things. Okay, and let me see. Oops. Oh, there's. Oh, I'm going to come back to that one. Ooh, that was a psychology session. Okay, I got to show you that. And then where am I? In corporate finance. Now I'm adding some stuff here. Did I put it here? This is. I'm going to put a PowerPoint. I'm going to put all of these things ranging from how to the model themselves to how to read in the data to the stock price file. I'm not finished, obviously, with it. And I'm also going to show you in much greater detail, which something a lot of you will close this off and not worry this, how to really get data. In this case, from different sources. In this case, it's from the SEC. So let's go back. Oh, and I put this scatter plot thing. That's what my mind was going. That's what I wanted to do. I put this little thing on there somewhere. And then this is what I was looking for in the, now this is from a different, very simple example that I did with a class. I remember this class. We had a class during Hurricane Sandy. We didn't do it online. We actually, in New York. Oh, that was wonderful. You make a forecast and you show the ROIC and the growth next to how you're going to get the value. Okay, now we'll go through all of the gimmicks and we'll go through all this until you show me what the WACC is compared to the return, what the growth rate is, and then show me how you're deriving this value. And you can think about it, different valuations. Until you show me that, I don't think you have much. And unless you show me the history together with the forecast, I don't think you have much either. So that's where we're going. I'm going to, unfortunately, make this, I suppose I'll call it the Amazon Valuation Series, which is kind of stupid, as if I know anything about Amazon and if I have any answer. But I'm going to have to do that. Now, I've gone through this stock price database and a couple of other ones, but I keep doing this, okay? And again, this time I want to go through it perhaps a tiny bit more slowly. So and I'm going to show you just for a minute some of the technical things, so you do not get afraid of doing this. So you know this has got all of the stock prices, and I start with what I don't know, an index. This could be the oil price or something else. This is the S&P 500. That's the one I almost always use. Now, I put up here, you can click on these and it goes to finance.yahoo and retrieves this. This retrieves some stock prices from the Federal Reserve Economic Database, Fred. And you can read oil prices and all this. Right now, this is a monthly thing. And then you can read at kind of any stock you want as long as it's tracked on finance.yahoo. This Google thing, I used to use it because a few stocks weren't there. This finance.yahoo is just fantastic because they have something called the adjusted a stock price, which accounts for both the reinvestment of dividends and the share split. The reinvestment of dividends is a real big deal. And then you can read all the economic series, the bond rates, the inflation rates, and a whole bunch of other stuff in there. Now, this is kind of a mess. If you wanted to add your own stock price in there, you would go through here, and the first thing you would do is you'd clear all the sheets. What that does is it goes through this thing called break sheets, and in here I just collect all the data. Here's some economic data. This is the U.S. GDP, which was in that is since its nominal GDP, which is there since 1947. Okay, and then if you this is I'm sorry, that's where they go. So if you hit this clear sheets, it clears all that stuff out, and then you hit one of these that says read either here or here. And I remember kind of which airport I was when I was making this. You can hit this one that says read stocks. And you can see how I tried to use a little bit of match index to show all the options that you select. So I had to kind of get them in different columns, and then ultimately, I mean, there's a little match index. It puts a nice little whatever. It puts everything together, whether it's an economic series or oil price or anything else like that. That's how it works. So I'm going to make this series a little bit more like this. Now back to that read Yahoo stocks. All you have to do is find the ticker symbol from finance.yahoo, and you can add stocks or take them away. And what I did is put some samples over here, so you can just put an equal sign if we want to put equal over here. If I wanted to take this range resources, which I don't know don't want to do, and then I want to make the sheet name and the list, that I can do that. I'm going to put Apple back here because Range Resources is a shale gas company that might well be bankrupt. But maybe not. I don't think it was. In fact, I think it might be down here. There it is. It's already here. Okay, so you can just do that, and when you do that, you press read all the Yahoo stocks, and I made some other videos that explain in kind of gory detail on how to do that. Now, if you want to do that, I've been working on my website a little bit during this crisis. I heard that Isaac Newton, though he was confined. He was confined in a little room during the pest, during the plague. And that's when he came up with the theory of gravity and integral calculus, a bunch of stuff. I don't know. That's fascinating. All I'm doing is working on my website. I'm not comparing myself to anybody. Trust me. But here, this says creating databases. And after you hit this creating databases, you go down to this technical details of reading stocks into the database. And it goes through kind of how you go and find stuff. And it has some of the macros, and it has all of that stuff there, and I probably have to put a little more there, and I'm working on it in my horrible confinement when I can't leave, and I'm so sad. Okay, now, so after we do that, let's look at some things. Now, here's something. Of course, what this finance.yahoo does is it went back to 1927, which I love, and the fact that if you look at the peak in 1928 or something, you have to go all the way, this is in nominal terms, to 1955 to get back there. Oh, God, was that a crash. Uh, and I wanted to make sure everything works. Now, if you let's look at an index. Let's start maybe in the 50s. It's not that long ago. Some of us might have been born in that decade. I'm not admitting I did. And then we'll go all the way to today. And we can do a lot with just this little thing. Now, what I've been obsessed about now, and I have to press recalculate a lot. And at first, I tried to get it all automated so you don't have to do this. Now, what I find interesting is Mr. Damarudan and everybody. Now, when I did this class, there was another guest lecturer who said, "Oh, you've got to read." I can't pronounce the guy's name properly. You've got to read Damarudan. He knows everything. He says the market risk premium, the risk premium over and above the bond rate is about 6%. Now, if you look from 1950s, you could look to 1960s, the nominal, not the goddamn real, the nominal IRR, which is finance.yahoo, you take the end value versus the beginning value, you either compute an IRR or do a growth rate, it's the same thing. And then let's find not the India interest rate, let's find the 5-year treasury. And let's also put the 10-year treasury. And what's kind of interesting to me, maybe not to you, now we can start assessing these idiotic assessments of the equity market risk premium, which is central to valuation, central to the WACC. And I'm getting a little bit off track, but I don't care. And When people tell me, "Oh, if you've got a stock trading on the Hong Kong exchange, you've got to use the Hong Kong index, not the S&P." What complete bullshit! You can diversify your stocks. Somebody, you have to say, if the only reason to not use a wide index that's correlated to a lot of other indices is, at least in CAPM theory, and even though I hate it, I used to testify it on all the time, and I'm trying to find my old files so I can put them back on the website here. I'll show you where in a minute. Uh, um, Please use a wide index. If you compare, let's compare the Dow Jones to the S&P 500. Now the problem is the Dow Jones didn't start here, and when you do this, you have to start in 1985. Now, on all of this, I struggled with this. And you can say, "Oh, I can do this. I just got to go to a website. Probably Bloomberg does this." I have no clue because I could never afford Bloomberg and I can't even find friends to help me. They're so highly correlated. That's kind of ridiculous. Okay, the Dow Jones was a little bit higher of an IRR, probably because they took GE out and replaced that with Amazon and stuff like that. Okay, but basically they're the same. Okay, so somebody who moans about taking one index versus another, kind of ridiculous. Here's the latest thing. I haven't updated this, by the way. Okay, and now I'm going to remove this. And now let's go back and go back to our original kind of issue. I'll start in 1959. How's that? I better put the recalculate button. Okay, and now I had to do some things to take that Fred data. If I go from 1959, this is kind of interesting. And the 10-year, look at 10-year versus 5-year Treasury. The 10-year gives you a higher return because you have more inflation risk. You could make a very good argument that the 10-year return is nothing like a risk-free rate because you take inflation risk, and stocks don't have the inflation risk. What's interesting is the 10-year, the IRR is not very different. Now, 59 might have been a bad year to start. Maybe there was I can't really remember back then. Okay, and then so we can look at now, since if I start in 1952, there's a little bit of a risk premium. 10-year always has more than the 5-year. Okay. But there's not much. And in fact, if you stopped back, before the people started really complaining about dispersions of income and all this, I'm not going to get all uh, into that. The premium was basically nothing, and I could start different places, and we could measure it all. So when you see these high equity market premiums and high WACs, please take an open mind. That's what I want to do in these in in the classes, and probably in the classes I won't moan. I'll do a poll right now. Should I shut up about this stuff and get on to the real modeling? And most people will say yes, shut up. Okay, but we'll do those kind of polls. That's what I hope, that how the classes are going to be different and practical for you. Or somebody might say, show me how you downloaded these files, and then I'll take a little digression, even if one person asks. Now, since then, if we kind of start, let's start here. What is this? I can't see that. Is that what? Oops, I can't. What year is that? I can't. I need to find the year. Whatever. That looks like about 97, maybe. Okay, and then we do that. We have to recalculate. Press the recalculate button again. Don't worry about that. Now there's kind of a difference, but even so, it's not that different. And the other thing is, I think when we look at long-term data, we should put it all in inflated, in deflated terms. So we recalculate it now, and it looks different. And here's the return in real terms, and here's the premium. The premium really shouldn't be any different, but that gives me kind of a better picture of really what's happening. And this issue about uh, where the market is, kind of it's got a better picture. It's not so extreme. You can see just how big that uh, 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 decline around the year 2000 was, which brings us to the next issue. Now, what I really want to do is keep digressing and talk about GDP versus stock prices and talk about dispersions of income and all that, but I'm not going to. Okay. Instead, let's start looking at Amazon. And I'm tempted to look at some of the other companies like Marriott and oh God, I better recalculate that. And now I'm going to reset everything. Okay. And recalculate. And Marriott didn't start. This is what we always have to kind of be worried about. Marriott started in their stock price, at least when it was followed by finance.yahoo.com, started in 1993. So we just press recalculate again. And here's what I really want you to do. I'm very, very serious about this. Uh, I would love it if you tried this and it doesn't work. It doesn't work. And then when it doesn't work, you give me a call. Now, what a perfect time to look at betas. This decline compared to the market decline is enormous. Now, this isn't a representative time. The beta here is 1.26. The volatility, which is the standard deviation of the percent change in the stock price annualized, is about double. Is it better to look at relative volatility, which doesn't account for portfolios? I think the Markowitz who came up with this portfolio was brilliant, really brilliant, saying that I can invest in the whole economy and then I don't have more risk than the whole economy. If we really want to put it in simple terms, that's what he was saying. And here, this difference in IRR of about 11, that is this number versus this. And we can see that if you invested starting in 93, you invested in Marriott, your one USD would have become 18. The market would have given you 6. Even with this decline, now, of course, we can go back to, let's just put, I could have done this monthly, but then we have to put too many drop down boxes, and you can see how to do this. Just a minute. I might have to go back to 2000. Excuse me. I was so worried about the end. I've just kind of found a problem. Before the decline, there, look at there. You can see the difference in the beta. You can see that beta is not static. So when we can talk about valuation, we have to be worried about this. Now, I know a lot of times what happens is people say, "Shut the hell up," because I'm going to use the CAPM because everybody else does that, and I learned that in school. Fine. Go do that. But here, the difference, you would have got 7 from the market, 34 from Marriott. That's before the kind of last big crisis. Now, of course, now we'll start looking at Amazon. Okay. When we look at Amazon for our case study, okay, I'm gonna just get rid of everything. So all I do here, it's a little macro, and you can right click on any of these macros and see how you do it. You put assign macro and edit, and all it does is it goes around for how many true falses we have, and it just sets everything to false. I haven't looked at this in about 5 years or something when I did it. Okay, and so now we just have the market and it's in nominal terms. We didn't deflate it. And now I'm going to compare it to Amazon. And that's the thing we're going to value. Now, before you look at this, first of all, we better understand that Amazon must have done its IPO in 97. Can you imagine if you would have invested in that IPO? God, that makes you sad, I hope. And then, but before you look at that, let's look at what happened to Amazon when everybody was talking about the new economy. And I'm almost afraid to say it because everybody was saying the new economy, it's a new economy stock. Now, if I compare the S&P to the Nasdaq, Okay, I'm hoping here's what I'm hoping you get a little bit out of this is that you say, oh man, can't I just do these little things on the graph? Wouldn't it be nice if I can do that? Maybe you can use Power BI. And my son said, oh, use Power BI and all that stuff. And just a minute. See, I took the wrong NASDAQ. I was just about to close down my whole computer and be totally embarrassed, but that was the NASDAQ from you can get the NASDAQ from the Fred data. So the NASDAQ had this big increase and then it wiped people out really badly. If you invested in here, this was a classic bubble, and you have to worry about that in all sorts of things you do. And really, for Amazon, we need to understand how much of the value is real, or maybe it's like those people said, maybe it's just a gigantic bubble. Now, so again, when I put Amazon here, and I remember a discussion I had with some people who told me, what bullshit is it to invest in Amazon? How can you believe them? Look at what happened to them. We could even start in maybe if we start in 1999, it won't be so bad. I'm having to press recalculate again. Okay, and they told me, it had started going down, so I'm gonna do 98. And they told me, if you assume every single book that gets sold in the whole world is sold by Amazon, you can't justify this value. This was the biggest bubble ever. What an idiot. And poor Jeff Bezos, you must feel sorry for him. His value went way down. And everybody said this whole business of the new economy not paying attention to classic kind of metrics of rate of return. What a lot of crap that all was. That we proved it. And people who were old fashioned like me were smiling and say, we're smarter than you. And then, then Amazon kind of went back. It started going back up again. By 2005, it kind of recovered some of its value. Now, Amazon had a gigantic beta here, so suggesting it's so much more risky. And again, I hope you ask, will that beta come from here? Really, is this beta a good measure of risk or not? The volatility was certainly high. And then, of course, if we take it to, let's just take it to, how about 2013? By that time, uh, this looks minor and the value had started going up. And of course, maybe that's the strategy. The beta went way down. The beta is completely unstable. Volatility is a little bit less. And then somewhere in about 2019 or 18, Jeff Bezos divorced his wife, and his IRR from the time you start was 33%. Not a gigantic IRR, but that 33% IRR is enough with a lot of growth, makes him the richest person in the world. And actually, I'm having a little problem with my little 2020, and I'm going to have to adjust that. Okay. And then the amazing thing is, with this corona crisis, it went even higher. We kind of all know that he made a few billion since the corona crisis. And if he invested one with 33% compound return, he gets 489 compared to the rest of us little schmucks who get two. That's why he's the richest man in the world. Okay. And uh, uh, hopefully that goes through some of the valuation issues now. Okay, so I've gone through some of these slides, and now I'm gonna, for me, this is a good one. I wish I can't get this from finance.yahoo.com. This is the TASI index going back to 2006. You can get that on Google Finance. Why don't they don't have it? Because it is the class. Here's the S&P 500. This bubble going up to 8 times and then coming down all the way here. Again, it's just if you talk to somebody from Saudi, talk about taxi drivers, school teachers, all of these people, if they saw their neighbors investing in, let's say, Amazon or any Saudi stock, and their stock was going up, they said, why am I teaching school? Why am I driving a taxi when I can just put some money in the market and it always goes up? It happened in 26. It's just a bubble. There are bubbles. Is Amazon a bubble? Because you get a resentment. Why didn't I invest in Amazon? So everybody says, I got to invest in Amazon. Is it? Is it? And then when we invest in Amazon, the price goes up. It just keeps going up and up and up until suddenly stops and does a real valuation. And that's what we're going to do in the next set of slides. We're going to start making a real valuation of Amazon. And here is just a little illustration of this valuation I just did for the class, and that's what I'm going to do for all of my classes, where we put different characteristics, different growth rates. And when I put growth rates, I said, what's this growth rate compared to the economy of the whole? I used US GDP. If we assume a higher growth rate, what kind of crazy assumptions when you compound growth rate for a long time? So in this case, it has a low growth rate. Now, this is just an output sheet. And what happens now, their cost of goods sold has been coming down, their margin has been going up. Can they really keep making a margin when you think they're buying something and reselling it? And everybody else can not, they have very unique ways of doing things. There's no question. The websites, the logistics, everything else. I know that. I don't know that. Whatever. And if we make this kind of growth that's declining with this kind of margin, then with some other assumptions about a WACC, a pretty low WACC, and then we use different valuation techniques, we can see what kind of valuation we get. I am not like that Tufts thing. I'm not saying that I know what the valuation is, but I'm going to walk through in the next a few videos just to practice again. And I would love feedback. If this was a real course, I would demand that you stop me. I would demand that you ask questions. I would demand that you shut me up. I would demand that you ask about details of the class. So we're going to look at this. And in the meantime...
Hi, Mr. Martin. Appreciate you coming to reach out and talk with us here. Is that how you like to be called?
Mm-hmm. Yes.
So I'm wondering how I could be most helpful for you during this conversation so that it's useful for you.
I guess I just need help figuring out how to cope with taking care of my father and my brothers